Now, having these financial institutions, the purpose of this is to promote efficiency, because if we rely on direct funds transfers or a direct transactions between individuals and other small businesses, it's really inefficient because you have to get the paperwork which you are not specialized on it, and you need to pay for your lawyers and others, and like some agent in order to facilitate that. So that's not it does not promote efficiency. So that's why it is recommended that financial institutions are there to do the transactions and help the decision making of the part of the investors to select like which companies are where to invest them. So they develop some portfolios and give some advices that this one is good, this one is highly risk, this one is having high return, like that. So now the investor now will be having like other parties that could guide them and could facilitate the transactions even without them putting some time or spending some time to it, and which could be more costly on their part. So in theoretically, we are going to discuss the different financial institutions and how they are what I mean differentiated from each other in terms of their primary functions and what they're doing. But again, these particular institutions actually they are in conglomerate like that. They are under in one company or one umbrella that having different purposes or different businesses. So that's why you cannot tell that if that particular conglomerate is investment banks or a commercial. So that's why it happens like that. But however, for the purpose of this discussion, we are going to discuss each of these financial institutions. So number one is the investment banks. There are three identified that are what are the doings of investment banks. So first is they design securities, because it's not the expertise of the corporation to design securities. So it's the expertise of the investment bank. So they design securities with features that could look more attractive in the part of the investors. So they offer that to the corporations, and the corporation will let them the investment banks to buy those securities, or it could be like that, or it could be they will offer them to another party or financial institution. So it's depend upon, but part of what the investment banks are doing is that they buy the securities. Then once that they bought the securities, they are going to resell them to the savers or to those potential investors. So basically, this is the function of the underwriter. So they buy the securities from the corporation, then later they wait for a certain period that the securities could go up, the price of that, and then once that it go up, then if they believe that that is the maximum amount that they could gain out of selling the securities, then they will sell that, and in that way they can gain something out of the transactions. Well, in the past years, there are investment banks that really were not able to survive, like the Bear and Stearns, and which was acquired by J.P. Morgan. And also, if you remember, the Lehman Brothers went bankrupt and Merrill Lynch, so they were sold to Bank of America. I think Lehman. I don't know if the Lehman Brothers are acquired. The two surviving major investments, like the Morgan, Goldman Sachs, they have received some approval from the Federal Reserve to become commercial bank holding companies. So that commercial bank holding companies. So these Morgan Stanley, since they have the approval, so they act also as commercial banks, like just like with the Bank of America and Citibank, Wells Fargo, and other that are really very what they call this familiar banks. So because there is another function, so they receive savings from savers and they lend money to the borrowers, and that's basically their function. And of course, this is another what their another function, like financial services corporations. Yeah, just like with the banks, they do that. So most of them corporates start in one area, then now diversified, like that. City groups like Citibank, investment like the facilities risk brokerage organizations, like having also insurance and leasing companies. So those are the related. As you see, these are also what the commonly the banks are doing. And we have some minors like credit unions, like cooperatives, association with the members. So they accumulate their funds, they combine, then the issued loans to their members, and might be for the also outsiders, but primarily they issued some loans to the members. Pension funds are discontributed from those who are pension holder or policy holder, and yeah, and these funds are invested by the corporations to different opportunities or portfolios. So, and just like also the likewise the life insurance companies are the same. Okay, and mutual funds are corporations that accept money from savers, then use the funds to buy stocks, like that. At this time, yeah, as you see, mutual funds they will provide. You invest like 100,000, then to promise that they can provide you the returns, but it depends upon the performance of their funds. But however, you don't know where they invest, so it's them to decide for that. So what you're going is just to hope, to be hopeful that the investment is really earning something that is expectedly high as that. So that's how the mutual funds works. Well, it might be important for you to know what about the actively managed funds and index funds. Well, actively, well, the selection of the are the I mean the managers of the funds are actually active in the selection of your what I mean of the stocks where to invest or securities where to invest the funds that will give the highest possible return. The index funds is there's no active selection of that, so they will just depend on referring to which securities are performing like that, and they just buy those and stocks and just hold for a while, then like that. So there's no actively like doing some research about the company or about the portfolio like that. Um, like unlike with that is done by the actively managed funds. Okay, so among the thousands mutual funds, we have the Value Line Investment Survey and the Morningstar Mutual Funds. These are available most of the libraries internet. You can see morningstar.com actually in the internet. It will provide like information, just like with the yahoo.com, yahoofinance.com, that provides the information about the companies that are listed in the stock exchange. So the New York stocks, like Chicago, like that. And so AFTs or traded funds, these are like treasury stocks or like corporations. They task the mutual fund companies to buy their stocks like that, and hold for a while, then looking for opportunity that the stocks will go up, then they will issue the stocks like that. So it's the same concept actually. Hedge funds are also similar to mutual funds because they accept money from savers, just like, except that the hedge, the purpose is for the hedging. Um, while mutual funds and EFTs are registered in the SEC, hedge funds are largely unregulated. Like, yeah, you can have a lot of hedge fund because, well, it cannot be actually regulated. Why? It's because it has a lot of purpose, a lot of securities that need some hedge. So we can, like from the foreign currency, it needs hedge. So that's another. That's why it's each you cannot do some regulation unlike with some securities doing by the mutual funds and ETFs.